All right, we are down 241 points right now. A lot of that has to do, not exclusively, but a lot, with a 10-year note at around 3.25%. That is the highest it's been in more than 7 years. You can add roughly, depending on what the borrowing rate is, the consumer rate, 2 points to that for a mortgage, because usually they're pegged about 2 points over what the prevailing 10-year is. So mortgage rates that in the depth of the recession were at around 3%. We're now looking at around 5 to 5.25%. Still very, very low, but not what they were. And it's that shock to the system that worries a lot of folks who see them only higher. And that's because of a strong economy, which in the past has been greeted as good news, but right now, worrisome news. And then you add, and this is my opinion, folks, and so write it down with a pencil and then quickly erase it because it means nothing. The added drama, what's going on at Capitol Hill right now, the markets would not like to see any surprises here. It doesn't matter whether you like Judge Kavanaugh or no. They don't like the uncertainty of having a Supreme Court seat still unknown for what could be months or more of uncertainty. And right now, it's as close as a tick. So anything that makes his prospect look a little better, I noticed the markets come off their lows. And then when we got confirmation that Jeff Flake looks like he is definitely going to be a yes vote, they come off their lows just after we had gotten word right now that Lisa Murkowski, who looked like a certain no, might not be a no, and then back to a no. So you can understand the gyrations. We'll graph it all out for you here. But the fact of the matter is it's not just rates. Again, that part is just my opinion here. Our experts know far more, and they join us right now. Gary Kaltbaum and FBN AM co-host Lauren Simonetti. Lauren, how are they reading it in the world that you cover? I mean, if this did not go through, this nomination did not go through, I would imagine it would be an unexpected development. Maybe they can live with that, maybe they can't, but I don't think it's something they've been counting on.
There is so much uncertainty with this White House, Neil, and I disagree with you here. I think this is a story.
Could we cut our mic, please, guys?
You got me. I thought that was for real. If you had a great shot when you first introduced this segment, and you showed the Dow sinking, and you showed the 10-year yield spiking. Happens at the same time. The low of the sessions for the Dow as we hit a new 7-year high for the 10-year Treasury yield. I think this is more a rate story, and I think in the end it is no big deal because we're moving towards the normalization of rates. I also know this. November, tricky time with the midterms. The year after the midterm elections is traditionally, we see a gain for the broader market of, on average, 15%, regardless, Neil, of which party wins. So I think, yes, the Kavanaugh nomination and the confirmation is uncertainty for investors, but we have so much uncertainty. Trade is another one.
You're right. All right. Other developments out there. Gary, what about you? I mean, we talk about, and Wall Street Journal was reporting this as well, that in midterm elections, markets do pretty well. Now, most of their oomph has already come long before those elections. So I could see that I could see it getting dinged a little bit one way or the other, but we'd still be up. But having said that, what is weighing on these markets?
Well, I'm just on record. I agree with everything Neil Cavuto says.
No, he doesn't.
Yeah, there you go.
Neil, it's not just interest rates. It is energy prices also. Gas prices are up 50 cents over the last year. That's $50 billion out of the consumer, and if it stays up, that continues at $10 billion for every 10 cents. You add in the interest rate front, and as far as markets, as soon as we broke out of range, what happens is money flies out of stocks into the money will fly out of stocks because of the worry and the competition for the money. So you have two things at work, and then you add in, I don't think it has to do with whether Kavanaugh gets in or not. It's just watching these people and saying, wait a minute, these are the people that are deciding on the future of this country. We're all worried about what is going on there, so that does not help the situation. And simple, cost of capital is going up on everything, and that affects earnings, affects profits, affects markets, affects economy, and that's what you're seeing right now to a certain extent.
Well, I do know, to Lauren's earlier point, the first sign of trouble on this interest rate development was in the housing sector when a lot of the home builders were taking it on the chin, and a lot of those who are very big into mortgage lending were taking it on the chin. So they're clearly feeling it on the belief here that it's going to slow that down. We've already seen that, I think, 6 months running now in existing home sales. There are other factors there as well, Lauren, but I mean, is there a sense here that the benefit of this improving economy now has to fight the headwinds of the higher interest rates that go along with it.
Yeah, absolutely. And I think the Fed has been pretty clear in telegraphing that they think the economy is strong, and the data has been pretty muscular. And now the bond market is kind of realizing, oh, maybe we'll catch up with the Fed, and the Fed is right that we will have a fourth interest rate hike in December. There was an 80% chance that was going to happen yesterday if you look at the Fed funds futures, and today it's 87%. So I think the bond market is saying, oh, well, normalization of rates is actually coming. So I think you see bonds catching up with the Fed here.
Real quickly, Gary, you and I could remember when rates were much higher. This was long before, for example,
a lot higher.
Lauren was born. But having
I was
said
born,
that,
but I didn't have a mortgage.
Oh, there you go. But perspective is everything, right? I mean, this is a jolt to people who've gotten used to ridiculously low rates. We're now getting back to a norm that might not be helpful to a lot of folks, right?
The words are used to. What markets have been used to, what the economy has been used to, has now changed, and that's the worry. And let me just give you by the numbers. A $200,000 mortgage now has increased interest payments by $30,000 to $40,000 over the life because of the move we have just seen. And if it continues higher, it goes higher. So you add in the energy prices with interest rates, it is a 1-2 punch that has to be watched because markets have been used to much lower on both. So time to watch this closely. And look, the market was already in trouble a couple of weeks ago. Half the market has not worked. Housing stocks topped out 9 months ago. Interest rate sensitive areas have topped out a while back. Housing related stocks like the Whirlpools are at new yearly lows. So something is going on here, and must be careful about it.
All right, guys, I want to thank you both. Lauren, I'm still weighing whether we ever get you back on. But no, seriously, guys, great job.